My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to another special West Coast edition of Mad Money. Welcome to Cramerica. How do you want to make friends? I'm just trying to make you some money. My job is not just to entertain, but to educate and to teach you. So call me at 1-800-743-CBC or tweet me at Jim Cramer. We need to talk about competition. Oh, it's the best thing in the world when you're a consumer, isn't it? It's how you get lower prices, better products. But competition is the worst thing in the world when you're running a business, or of course you own shares in that business. I think that's the biggest lesson from the companies that have reported this week, including today, where the Dow dipped 60 points, S&P advanced 0.34%, NASDAQ gained 0.45%. Yep, unbridled competition is wreaking havoc across a host of industries, and it's putting tremendous pressure on a number of stocks. In fact, that competition is extra deadly right now, and I'm going to tell you why. At the moment, big institutional money managers who control the largest pools of capital are searching for companies with two characteristics. They want fast revenue growth, but they also want rising gross margins. Everybody loves revenue growth, but if you don't have rising margins, you know what that translates into? It translates into the kinds of things that I most fear about. Maybe some companies are simply buying revenue at a ridiculously high cost rather than focusing on profitability down the road. You know, we don't know what an underlying company is worth if it can't generate actual earnings or is just buying revenues. So where does competition come in? All right. Well, when you don't have much competition, it is easy for your gross margins to rise because your customers don't have many alternatives. Few competitors translates directly into higher earnings and higher stock prices. This isn't a new idea. I created the term FANG and then added a second A, precisely because Facebook, Amazon, Apple, Netflix, and Google were all unrivaled companies with what? Fast revenue growth and expanding gross margins. The fact that most of these companies are within striking distance of their all-time highs or are there shows you the power of limited competition. Nobody's challenging Google and search. No one can touch Facebook and social media, not even Twitter, which we're going to have on later in the show. Amazon's been up and down solely because of its margins, but I think that's mostly under their control. Apple's had production issues, but we're now seeing that their phones are selling incredibly well, no promotions, and the stock hit a new high today, based on word that they're moving into homegrown electric vehicles. I've got an idea on Apple I'm going to share with you. I say own it, don't trade it. Then there's what's arguably the greatest market darling of this current era, and that is NVIDIA, which we're speaking to tomorrow. I can't believe we're going to the Oracle, the real Oracle, the Oracle of tech, the Oracle of philosophy. Yes, Jensen Huang. Now, this semiconductor and software company, notice I said and software company, we're not pitching it as a chip company. This is a titan, and it's got the fastest revenue growth and some of the most outstanding gross margins I have seen of any large company. And that's why I'm so thrilled to make the pilgrimage to their headquarters tomorrow. The quarter NVIDIA reported last night was truly a thing of beauty, hence the stock's gigantic 8% rally today. I read it from 1 a.m. to 3 a.m. today, and I'm still trying to understand everything they're doing. But I'm not going to stop. Now, I am thrilled that my charitable trust owns all these stocks save Netflix. Oh, and it's awfully hard to go wrong when you bet on companies with strong sales growth and rising gross margins. That's what I teach you when you join the CNBC Investing Club, which you know I'm urging you to do. Okay. Enough positives. Let's go to the dark side. The companies that haven't been able to deliver the 1-2 punch and what happens to their stocks. In many cases, these are victims of ruinous competition. Take the payment space. For years, financial technology was beloved, right? Fintech by Wall Street, we love it. Let's create some ETFs for it. The growth was extraordinary. The margins unassailable because there was plenty of growth to go around, not a lot of competition. But this is the quarter that many now claim is the end of the line for Fintech, especially since there's so much money going around to fund new competitors at scale, meaning that they have real heft from the get-go. Affirm, the buy now, pay later kingpin that we talked to earlier this week, is taking on the whole credit card industry, and by extension, their processors, Visa and MasterCard, the two kings. A firm just became the exclusive buy now, pay later provider for Amazon, something that would have been a nice plum for Square, given they just shelled out $29 billion in stock for Afterpay, another buy now, pay later service. And we know it means a lot to Macy's, too, as we'll find out later in the show. These are, and so one more, Klarna, which is a force internationally, may just smash everyone else's margins, including my beloved PayPal, a company with a once roaring stock that's now being crushed mercilessly almost daily. Even today, when a brokerage firm initiated coverage of the stock with a buy rating and it earned a big chunk of the business of Macy's. No, not happening. In short, the battlefield is now littered with fintech busts. And while we're buying PayPal down here for the charitable trust, can I just tell you something? And we also own MasterCard. The recent action is a humbling reminder that you can't afford to get cocky about a segment, a sector that had always seemed to be hot for years and years and years that's now gone cold. Second example, we're seeing the beginnings of a war in the electric vehicle space coming right out of nowhere. For a long time, this group had been immune to selling. We were at Lucid earlier this week, and until yesterday, owning Rivian was like owning Secretariat. Now, though, Ford has announced that it's doubling the electric vehicle capacity it has, and they'll have the chips to ramp up the production thanks to a special deal they made with Global Foundries. At the same time, we just learned that Apple wants a piece of the pie, too. Nobody has the kind of war chest or brand name that can compete with Apple, except maybe Tesla. When you see competition exploding all over the place like this, you've got with rich players, guys are loaded. You got to bet that gross margins are going to come down for the entire industry, and they're no longer just going to make money and do well because they're not unionized. That's the sell-off. Third, have you seen the gambling stocks lately? I mean, well, try not to. I mean, they're being crushed. They are just being annihilated. And why? Well, I mean, I can tell you why. It's because there's too much competition. Now, that sure wasn't the case when DraftKings came public via SPAC a year ago. It looked like they had the whole field to themselves. Then Penn National Gaming came in, real rivalry begun. They did that deal with Barstools. Then the companies with no real cost of capital, the casinos got into the digital racket. Next thing you know, profitability's been squeezed while the cost of acquiring new customers is shot through the roof. I don't know how you get a truce going in that industry. Without some aggressive consolidation, that might not get regulatory approval anyway. It seems like the days where digital gambling was just a green field are over. It seems uninvestable. Now, I do like the pure casino stocks, but they are caught in the morass. If you want to see a real sign of what declining gross margins can mean, take a look at Walmart, or maybe don't. Don't look at the stock, at least. Virtually every retailer is blowing away the estimates this earnings season because there's been very little discounting, very little promotion. For example, Macy's saw its stock soar 21% today. The week of an amazing quarter. Wow! But Walmart, it actually chose not to raise prices. It decided it wasn't going to have a good stock. It decided to be a price cutter. Wall Street's furious, and they took it out on the stock. Zero benefit of the doubt for the people running the largest retailer in America. Contrast that with Home Depot or Lowe's. They can do no wrong because they're passing on rising costs to the public. And the public has no choice, especially the professionals who buy stuff and then do over your house. Why do they have no choice? Because these two chains have single-handedly wiped out the competition already. There are no small hardware stores to speak of. Now, I know it seems like a simplistic way to judge stocks. There are lots of ways margins can expand. Maybe a company comes up with a better way to make widgets. Maybe management finds cost to cut. But that's not what I'm talking about here. Wall Street loves more than anything. What they want is when companies can make fortunes because they have little competition, they have tremendous pricing power, and they can keep raising prices on you at will. The bottom line, it's no secret that many of these Silicon Valley stocks trade at lofty levels precisely because these people, they have like no rivals whatsoever. But as we've seen from the meltdown of the financial tech stocks, you get complacent at your own risk when you got those fat gross margins. I say stay close to gross margins because they, more than anything else, is the coin of today's Wall Street realm.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.